What's going on, everyone? My name is Nicholas Merton here from DataDash, and today is August 28th of 2023. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's video, we've got to talk about how Bitcoin is entering its final countdown. As we approach a critical price level here for not only Bitcoin, but for the macro perspective when it comes to the broader performance of assets as a whole, we need to see bulls show up to the plate, because if they do not now, we are expecting some serious pain to come here in the next couple days and weeks. We've got a lot of things to dive into in today's video, so if you guys happen to enjoy the video, consider dropping a like, and let's go ahead and kick off the rambling. All right, so the theme today we're going to be focusing on is price action, and more specifically, we are going to be analyzing two key technical analysis components that we track here on the channel, and that is the pairings of the 200-day moving averages as well as the 200-week moving averages and our momentum indicator. And I got to tell you guys, whether we're analyzing Bitcoin or the broader asset markets, things are not looking good. I don't mean to be grim, I don't mean to be too negative, but I'm just being realistic with you guys here. The momentum has stalled substantially, not just in crypto, but also in equities as a whole. And I want to spend some time to talk about that. Now, why do I say that Bitcoin is entering into a final countdown here? Look, when I say these things, guys, I'm not saying Bitcoin is dead as a project, but it means that we are likely heading towards some serious pain, because right now, after price was remaining above the 200-week moving average in early March, which gave a lot of people the impression that, hey, it's a new bull market. This dip below the 200-week moving average, the first for Bitcoin to ever do so to such a substantial degree as it did, right? Usually in the past, we would see it dip slightly below the 200-week and then get bought up. Well, this time around, we had it for multiple months. And when we got above here, many of the bulls who ignored that period of time and that substantial time frame, we were below the 200-week, they thought, well, we're back above the 200-week, it must be a new bull market. It's a confirmation. It must be a new bull market. Why is that? Well, maybe they thought that was some technical analysis rule out there, but it's not, right? Just because something gets above the 200-week moving average does not mean it's a guarantee of a new bull market. And I think the past couple of months have been proof of this. We have fallen back below here, right onto the 200-week moving average. And it is a question of whether or not the bulls are going to show up here and buy at this price range like they did back in June. Because if they don't, and they can't come up here and clear through this point of resistance, then we are going lower in price, guys. This past couple of months will have been a deviation, a short-term window that trapped a lot of people into thinking we were in a new bull market. Unfortunately, a lot of good-meaning people who are using a lot of the same practices from prior bull markets, but we have spoken time and time again on this channel that we are not in the same bull market structure of the past. Essentially speaking, it is not an era of easy money. We are not in a period of time where the halving, which is growing weaker and weaker over time, is somehow going to save us. We have lacking innovation in the crypto space, a lack of new narratives and new users and developers, and therefore we are likely heading lower. There is not a substantial narrative here to drive liquidity to the crypto space, right? And it's not just me bashing on Bitcoin here, guys. It's assets as a whole. I mean, if we take a look at altcoins here, right? Take a look at total too, right? This is everything excluding Bitcoin, right? Again, we can see red flip here for multiple months here on the weekly time frame for the most part, and we can see that again we got a slight deviation, above the 200-week moving average, which are the orange and red line here. But again, we faded back down and have essentially been rolling under there, yet again confirming that we need lower price levels before we really move higher. Take a look here at total 2 minus ETH and stablecoin liquidity, even weaker here. We came up to the 200-week. And faced it as resistance. We didn't even get a deviation above the 200-week moving average. Time and time again, this was resistance. It showcases here that the bulls were not able to show up at the most critical time here, and that the bear market still has time before we're actually going to find our capitulative lows. Or at a minimum, we're coming back down here towards those prior lows. I think at a minimum, we are heading lower for a third pair of lows, as we talked about in the prior videos. Now, this comes all at the heels here of what happened on last Friday at the Jackson Hole speech, where Jerome Powell gave a forward outlook into the months and year to come about where monetary policy was heading, how the Fed feels about inflation, etc. Well, there were two things that I have to tell you guys that I took away from this presentation. It was a little bit longer than the prior presentation, and there were some clear steps that basically the Federal Reserve was likely prepared to raise rates further, which again we've been talking about here in this channel. We're not saying every single month the Fed's going to raise, and I'll get to that point in a minute, but essentially speaking that the target rate is going to go higher here, and that is going to cripple demand in the economy, and therefore it is going to cripple earnings reports and start to set a negative tone for equities and assets as a whole, including crypto. Don't think the crypto is separate from this, guys. The cost of capital and credit getting more expensive hampers the crypto space. It continues to dampen the performance of these assets. But outside of that as well, not only did the Fed kind of say that they're prepared to raise rates further, they had this statement of proceeding carefully at upcoming meetings. And I got to tell you guys, this is where the Fed is making a mistake here, right? I understand the optics of a statement like that. We want to proceed carefully. We don't want to tighten too much. We don't want to break anything. Look, the cold reality here, guys, is that the Federal Reserve needs to raise rates higher. It needs to tighten its balance sheet more. It needs to get inflation not just below the 2% target. It needs to take it to deflation for a few months. It needs to essentially make sure that the message is clear that right now, inflation is the #1 target. We cannot just raise another 25 basis points and then pause and see how things go, because you're just delaying the inevitable. You're delaying and unfortunately propagating inflation towards even worse levels if you don't actually set the tone that yes, we're going into a mild recession, we're going to deal with it immediately, we're going to get rid of inflation so consumers can have confidence when they go out and shop and they spend and they earn money. And we essentially need to make sure that we send that signal now and not kick the can down the road when some geopolitical event happens and crude oil prices shoot up 15-20% and spark another wave of concern where people are shopping and spending more than they normally would need to, which drives inflation even higher. Again, there's a psychological element. Even Jerome Powell has stated this around the Fed. That all being realized here, right? Even though there's this psychological effect around inflation and the Fed knows this, they have been teetering here, slowly raising 25 basis points here, 25 basis points here. And this just delays the inevitable. It's actually going to be worse off for equities because instead of just getting some mild correction, we could be setting up for a severe trend shift from a mild correction and then continuing upwards to a major depression. Something that could really start to hamper the economy if we have sticky inflation for the next couple years to come. The Fed needs to do the right thing here. But I got to tell you guys, this was not something that was per se bullish for equities. The Fed still just tiptoeing here is going to leave us in an environment where the Fed has to suspend interest rates at its target rate for a longer period of time. And this is why I think when we take a look at equity markets, if we dive here into the daily time frame, markets were pretty much unchanged. It wasn't incredibly hawkish news like the previous Jackson Hole speech, but at the same time, we're in this limbo where, we really, I think people are starting to realize we don't have the steam for a new bull market. Price action is telling us that here. When we're starting to get some of the news around AI developments, the fluff that had built up this rally over the past couple months and started leading people to pay even higher PE multiples for these big FANG stocks and technology stocks than they did before the November 2021 peak. You have to start coming into question here as to whether or not we've really got the steam for the new market cycle. Well, right now, the NASDAQ still here on the weekly time frame with our momentum indicator is still blue. I will give it that here. I'm going to be fair and say at the end of the day here, the NASDAQ as a whole is still blue. The bulls are still in charge here, even considering the 3-week pullback here we had throughout August. However, we are very close to getting that trend flip. We have dodged that bullet just so slightly here over these past 2 weeks. Essentially speaking, the pivotal point here is right around 13,000 points. So the question is, can we really start to get a bid and drive valuations higher here? Because if we can't, we are likely coming down to test the 200-week moving average yet again. And if we can't hold there, right, like we did back in June of 2022, and we snap through like September of 2022, I gotta tell you guys, I think it's gonna become overwhelmingly clear that we have yet to formulate our lows for this bear market. And if we haven't done that, then that means we're going back to 10,000 and lower. And that's why for a long time we've talked about this key level here, this level of consolidation between 2018 and 2020. We may need the train of pain to come. And yes, you guys are seeing that right here. I'm saying that around from 14,000 points here on the NASDAQ, we could come down as low as 8,000 points. Like, that can happen because of a simple factor: slowing earnings. And because of those slowing earnings, people coming to the realization that it no longer makes sense to pay a 30, 40, 50 plus PE multiple for big technology stocks that are no longer growing like they did over the last few decades. And again, I bring up this point: Amazon. How is Amazon going to scale or grow like it did during 2020? That was peak growth, right? So how is Amazon going to continue scaling from there on out? There's only so much it can expand to, only so many markets it can tap into. How about Google? How about Facebook? Right? These technology stocks can only grow their ad share market so much, and their user bases and their networks, right? And while they may still be technically growing to some degree, it's nowhere near the growth of the last decade. And the same goes for even Apple and Microsoft. You may believe in the AI narrative, but guys, there's only so much of a market share that these companies can go for, and they're all competing for it. And so far, that market share that they're competing for in this new AI sector is shrinking because essentially AI as a market right now is not ready for mainstream consumer usage. There is clear problems with these language learning models and their usability for everyday people. And again, just to kind of signal this here, I want to go ahead and bring your attention towards a very key metric here. What I'm showing here is a chart that we demonstrate within the Dash report that showcases a ratio of the performance of Apple and Microsoft by the S&P 500, or divided by the S&P 500. Essentially, it lets us know when these two technology names are swallowing up more market share of the S&P 500 or are starting to decline. And essentially speaking, while we can kind of ignore the number here, we focus on the trend direction of the chart. Since back here at the beginning of August, we got a weekly red flip here, and it's a pretty clear direction in the trend. After setting in a third relative high here for these technology names against the broader S&P 500, a clear double top here at around the 0.123 range here on the chart. And essentially speaking, if we continue lower here, if we cannot catch a bid up in this range, we're likely coming at a minimum back down to this range, which is going to be a substantial correction in these names versus the broader S&P 500. And I promise you guys, it is likely that if these stocks are going down, the multi-trillion-dollar stocks that Apple and Microsoft are, it is going to weigh down the performance of the broader S&P 500. When these stocks, the previous market leaders, are no longer serving as market leaders and they are lagging, it is a negative impact not just for them, but for the broader asset markets as a whole. It is showing a slow growth, risk-off mentality in equities. And we better hope, the bulls better hope here, that people come in and catch a bid like they did in December for these stocks, because if they don't and it snaps through, we're heading down towards some of the longer term lines of support that we indicated here within the Dash report. I'm going to go ahead here again, just focus on some of these lines here. We're talking about substantial corrections in these companies against the broader equity markets. And again, this can happen when people stop paying such a high PE multiple for companies that are no longer growing like they used to over the last decade. Again, Apple is not going to have another iPhone moment likely with the Apple Vision Pro or its potential push into AI. Apple's a great company. Microsoft's a great company. They are titans in their own right, and they'll continue to be relevant for probably the next few decades of our lives. That being realized, it doesn't mean that they're going to continue growing and that people can continue to pay the same kind of multiples that they did back over the last decade. Not to mention that they're likely going to just be the market leaders this next time around. FANG stocks as well, after setting in a slightly lower high here from their prior November 2021 highs, can't seem to get a bid here to climb all the way up higher and are looking very close to potentially flipping here on our trend indicator. The first time they would be doing so since back here, really I think since back in November 2021 when it comes to a blue to red flip, which signaled the continued downtrend from FANG stocks on the index going from 230 points at the high all the way down to 97. So if these stocks are not going to come and carry us into a new bull market, we've got to look for new market leaders. And until we find those new market leaders, stocks will likely move lower. That is a common principle. If you want to talk about like TA 101 or cycle analysis, That is a core principle of equities. You need market leaders. You need stocks that are showcasing that they're going to charge forward and become the next $1 trillion+ companies out there in equities. And unfortunately, we don't know who those stocks are going to be yet. They certainly likely are not going to be the ones that led in the last cycle. I mean, again, think about those stocks. Facebook. What has Facebook done innovative? Threads. Oh yeah, a copycat of Twitter. And for the Facebook platform, copying TikTok as becoming a potential, video content platform for short form content. Really? That's not innovation. That's stagnation, right? And Meta is essentially slowly but steadily kind of stepped back on a lot of its investments in the one thing it could potentially lead in, which is the metaverse, which is already a pretty spotty trend. Take, for example, if we're talking about the FANG stocks, Amazon, we already talked about that. Netflix, how is Netflix going to continue scaling like it did over the last couple of years? Its growth has stalled to a large extent. It started to really slow down. And they've started to focus on excess monetization tactics of cutting people down from utilizing multiple accounts. This is a late stage symptom of growth. This is essentially showcasing that the company doesn't have much more users to go after, so they need to focus on monetizing more in their existing audience. Not a good sign. Not what Wall Street wants to see. They want to see anything you can potentially give out for free, get as many users as possible, build out your network. But when you get to the dinosaur phase, that's when it's essentially a sell the news period of time for the company. It's time to get off of those. They're no longer growth stories. And Google as well. Google's a great company in many regards, but Google itself, again, still, the question is, can it lead forward in this new AI revolution? Is AI going to be the big trend? Because if not, it's essentially an ads business, like most digital businesses out there within the FANG acronym. The question is, can it continue to accelerate higher? I just don't think that's going to be the case, guys. And this comes at a time here where the Fed is not giving us any coherent trend, and oil has been trending up since back in late June. Is inflation really done with? Can we really rely on the Fed to just come in and print a lot of money when they're trying to battle against inflation? And they've been pretty gun-ho on continuing to raise interest rates, lower their balance sheet. And are the stocks that we trusted as being the leaders the last decade, can they really do what they did before? I want you guys to really just sit back for a moment and think about that. And I only say this with such a strong opinion because I want to do my best for you guys here to make sure you're protected at the end of the day. I'm not here to get you guys to FOMO. I'm not here to tell you the next latest greatest 100x altcoin. We cover crypto markets with a pragmatic, optimistic tone, right? We do believe that things will get better in the long term, and the same goes here for equities. But I got to tell you guys, we've got some fundamental questions to ask. And I got to tell you guys, I'm looking real hard to find answers that look optimistic. I really am. I know we focus on things here and they sound like it may be negative, but it only gets to this point here because I'm reaching for straws trying to find out what we can get optimistic about. But I've used AI tools. It's not exciting. They've gotten worse over time in my experience, and they were already limited at the beginning. People are paying ridiculous multiples right now for companies that are likely going to see declining earnings into a recession. And if the yield curve inversion, now on inverting, is starting to prove anything to us, if we look back through history, time and time again, it has been an untested indicator since back in the 80s, and essentially has proven that a recession is coming in the next few months. Which means that people are no longer going to pay the PE multiples. They're no longer going to continue with the optimism, the euphoria around the AI bubble that's been built up over the past couple months. And it's going to be a period of time where Bitcoin likely corrects lower. Bitcoin is going to be an asymmetric asset. It's going to lead the way forward. It's got to start showing up to the plate. Because if we take a look here, Bitcoin, in accordance to its performance against assets, is not only deviated back below the 200-week moving average against the NASDAQ, but essentially speaking, has not made any progress against the NASDAQ since December of 2020. Or more relatively here, since June of 2022. What happened to Bitcoin being the leading asset? Well, the reason it's not the leading asset like it has been for the last decade is because of a simple factor. Liquidity is contracting. And whereas Bitcoin did best during a period of time of liquidity expansion versus the broader stock market, I feel very confident that in a period of contracting liquidity, it is going to be one of the worst performing assets. And people are going to be so shocked. They're going to be so surprised. They think, well, I heard about the halving, and I heard about the Bitcoin bank run, and I heard about the BlackRock ETF. And sure, maybe those narratives didn't work out or hold up, but why is Bitcoin going lower? Why is it going down to 10 to 12K? It just didn't seem possible. It's because so many people ignore the fundamental reality. We can't say that liquidity is going to drive up asset prices and give us a reason to buy every dip, yet ignore when liquidity is contracting that every rally is an opportunity to sell assets at a premium, expecting further lows and continued roll downs in price. I rambled on a good amount here, guys, but I want to ask you guys of two things here. If you've made it this far, if what I'm saying sounds like music to your ears, or at a minimum is opening you up to a different perspective, I highly recommend you guys consider checking out the Dash report down below in the description. You guys can get 20% off. It's our newsletter here on the channel. You can get 20% off if you sign on an annualized basis. Even if you're just a viewer here on the channel and you want to find a way to support me, this is a great way to do it, because not only are you supporting the channel, what we do here, all the free content that we put out, but you're also getting that additional layer of really juicy information, such as our trade alerts. You're getting a 20-page report each month where we cover crypto, stocks, commodities, and Forex, a 360 view on what's going on across the board, where opportunities may lie outside of what other crypto channels may miss. Essentially, as so many people are pigeonholed on just focusing on the crypto space, you can trade in so many other markets, and there's opportunity laying out there for you guys, even during these corrective periods. We can go long, we can go short. And outside of that as well, there's the Dash Report discussion group, a really great community of people of great sense of humor, great knowledge, great input, and ask a lot of great questions. And you can even ask questions during our mid-month webinar that we do in the middle of each month. So there's a lot of great things that you guys will get out of the Dash Report. And again, at the end of the day, if you're just looking for a way to support the channel, maybe get some additional content, it's the way to do so. We don't really have our Patreon or anything like that, but this is something where, again, I want to give you guys a way where you can not only support the channel, but really get some really great input and additional details on where the market is heading, where we think the opportunity lies in the market. And I got to tell you guys, for those of you who are still here, by the end of this video, we have some really key markets that we're focused on here. As we expect corrective valuations while we are looking to short here in the market, at the same time, there are some stocks we really want to buy dips on, and we think are going to be those market leaders for the next cycle, both in equities and in crypto. So we hope you guys will potentially join us here in the Dash Report community. We've got hundreds of great members in the Dash Report community, and we'd love to have you guys join us there as well. But I rambled out a good amount here, guys. If you made it this far, consider dropping a like. It's one of the greatest ways you can support the channel. But until the next video, I'll see you all in the next one. Take care, everyone.